Hello, my name is Kenneth Himmler Sr., and today you're going to learn about ineligible rollovers in and between different IRAs. First, there's two main categories. The first one is decedent IRAs. If you are married and your spouse passes away, at whatever age they pass away, you are eligible to elect that IRA to become your own or stay as a decedent IRA. Now, as a spouse, if you elect to roll that IRA into your name, then it now becomes your IRA. The only people that are not eligible to inherit a decedent IRA is a non-spouse. That means that if you had a mother, father, brother, sister, aunt, uncle, grandmother, grandfather that passes away and they leave an IRA to you, a lot of times people will take that money out under the 60-day rollover provision. They will then add that money back to their own IRA. Now, typically the financial institution will catch this mistake if you do a trustee-to-trustee transfer. This is where you don't touch the money, you don't get a check, you just ask one financial institution to roll it from theirs to the new one. They will usually catch that this is a mistake. I typically see the mistakes happen when people elect for the 60-day rollover. That constitutes an ineligible rollover. And what that means is you have 60 days from that period of time to unelect or fix it, get it back into a decedent beneficiary IRA. If you do not, here's what the consequences are. One is the entire amount of the IRA becomes taxable in the year that you roll that ineligible IRA into your own. The second problem is if you're under 59.5 years old, you will incur another 10% penalty on top of that. Now, the second category of ineligible IRA rollovers is when you move money from an IRA to a simple plan or from a simple plan to an IRA plan within a 24-month period of the first date that you add money to the simple plan. Let me give you an example. Let's say January 1st, you put $1 in your simple plan. And by December 31st, you decide that you want to roll that money from your simple plan to your IRA. That is an ineligible rollover. Now, here's the tax consequences. If you're under 59.5, you will pay 25% penalty to roll that ineligible SEP to an IRA. Now, here's the bad part. If you're over 59.5, you will pay 25% penalty. The age difference doesn't matter with a simple rollover. In addition to that penalty, which is draconian to begin with, you will now also incur the full wrath of the income tax, both federal and if you live in a state that pays state income tax, you're going to pay all three of those taxes. So you must be very careful on not rolling money from a simple to an IRA or an IRA to a simple plan within that 24-month period. Today, you have learned about receiving or rolling over ineligible rollovers for an IRA. And my name is Kenneth Himmler Sr.